Have you ever noticed how often you see those headlines? Major companies laying off thousands of employees. It almost always sounds like, well, like a bad sign, doesn't it?
It really does. That's the immediate reaction.
But have you ever stopped to really wonder about the actual financial costs? And maybe more surprisingly, the benefits for the companies themselves when they make these huge cuts?
Today, we're doing a deep dive into exactly that, the surprising financial impact and the cost-benefit side of things for large-scale layoffs. We're looking at major S&P 500 companies
Right.
and focusing particularly on the tech sector, say from 2020 through 2025. That period saw a lot of this.
Yeah, it certainly did. And our mission today really is to unpack some real concrete examples. We're talking giants like Meta, Alphabet, Amazon, Microsoft, even Tesla. We're going to peel back the layers, look at the big upfront HR costs involved, and then crucially see how these strategic and sometimes, let's face it, controversial decisions actually play out on the company's financials.
Do they actually save money in the long run? Exactly. Do they really lead to those long-term savings they talk about? Hopefully by the end of this, you'll have a much clearer picture of why companies make these tough calls and, what the numbers are really telling us.
Okay, let's get into it then. When a company announces mass layoffs, it's not just like saying goodbye. It sounds quick, but what does it actually cost them right away? What are those immediate hits to their books?
You're right. It's definitely not simple. Layoffs, well, they actually cost a lot in human resources. HR costs.
Right.
The biggest things are usually severance pay. Then you've got extended benefits coverage like health insurance and often career transition services too. Help finding a new job.
So actual cash going out the door.
Serious cash. We're
Yeah.
talking about really significant upfront costs per employee. Especially when you think about those high salaries in tech, it's not just see ya later.
Yeah.
It's see ya later, and here's a pretty substantial check.
Can you give us some actual examples? Like, what did Meta and Alphabet pay out per person on average when they made those big cuts we heard about?
Sure, so Meta, for instance. Back in November 2022, they laid off around 11,000 employees.
Yeah, I remember that.
They ended up spending nearly $1 billion just on severance and related costs, about $975 million, to be precise.
Wow, per person.
Well, if you average it out, yeah, it's roughly $88,000 per employee, which reflects some pretty generous packages, actually.
Like what?
Things like 16 weeks of base pay, plus another 2 weeks for every year they'd worked there, and 6 months of health insurance continuation.
That's significant.
It is. And remember, they had a second round of about 10,000 cuts in spring 2023, which added even more charges later on. Now, Alphabet, Google's parent company, they cut 12,000 jobs early in 2023.
Right.
Their severance costs went even higher, came in around $2.1 billion by the third quarter of 2023.
$2.1 billion.
Yeah, which suggests an average severance way over $150,000 per employee. That lines up with, Google's typically high compensation levels.
Oh.
And what's also interesting there is they had another $856 million in charges for things like getting out of office leases. That was
Yeah.
part of the same restructuring effort.
And it's just a staggering amount of money.
Yeah.
Just to let people go. Okay, what about Amazon and Microsoft? Were their costs in the same ballpark, or was it different?
Amazon's corporate layoffs were big too, around 27,000 people in total across late 2022 and early 2023.
Right.
Also costly, but the average per employee seemed a bit lower. For their first round, about 18,000 cuts, Amazon reported a $640 million charge.
Okay.
If you average that, it comes out to maybe $35,000 per employee.
Much lower than Google.
Much lower, yeah. And that's likely because of the mix of roles affected, maybe more warehouse or less specialized corporate staff and potentially shorter severance deals. Maybe around 8 to 12 weeks of pay, something like that.
Gotcha. And Microsoft?
Microsoft cut about 10,000 jobs in January 2023. They took a big one-time charge of $1.2 billion for the whole restructuring. And about $800 million of that was specifically for employee severance. So do the math. Works out to roughly $80,000 per employee.
Similar to Meta, then.
Yeah, in that range. And their package also included things like 6 months of healthcare and career transition services. So still a lot of money, but quite a bit less per head than Alphabet.
Okay, this is what gets really interesting for me. Tesla. They always seem to be the outlier, kind of marching to their own drum.
Yeah.
What was their approach with severance, and did that carry any risks?
Tesla's approach is, notably different. Their severance payouts, generally pretty minimal.
Minimal how?
Well, for example, during layoffs back in June 2022, many staff who were let go reportedly got just 1 week of pay as severance.
1 week. compared to 16 weeks plus at Meta.
Exactly, which of course means much, much lower immediate HR costs per employee compared to the others we've talked about.
Yeah, surely there's a downside.
Oh yeah, this minimalist approach actually led to legal trouble for them. Tesla got sued under the WARN Act.
The WARN Act.
Yeah, it's the Worker Adjustment and Retraining Notification Act. Basically, it requires companies to give 60 days notice for mass layoffs in many situations. Tesla apparently didn't. So it really highlights the legal risks you run if you provide inadequate severance or notice, even if it saves cash up front. And then in April 2024, they cut over 14,000 employees again, and the assumption is they probably followed a similar minimal severance path.
So that raises a big question. Why does this cost per employee vary so much? From, maybe $35K at Amazon to over $150K at Google, and then almost nothing at Tesla.
It really boils down to a few key things. First, just the generosity of the severance terms themselves. Are we talking multi-month packages like Meta and Alphabet, or, the minimal route like Tesla?
Right.
Second, the average pay level of the employees being cut. High-paid engineers, for example, they naturally cost more in severance because it's often tied to salary.
Makes sense.
And third, you've got local legal requirements. Different places have different rules about minimum severance or notice periods. Plus, companies often throw in extras like counseling or job placement services. And, like Tesla discovered, legal costs can definitely pile up if layoffs aren't handled by the book. It's actually a pretty complex calculation.
So, okay, they pay these huge upfront bills. The next big question is, how does Wall Street actually react? Do investors punish companies for these massive charges that obviously hit their quarterly profits? Or is something else going on? And how do these costs actually show up on the financial statements?
Right. So these layoff-related expenses, they typically appear as one-time charges, usually called restructuring charges.
Okay.
And these directly reduce the company's reported profit in the quarter they happen. But companies are usually pretty careful to label them as non-recurring, meaning they tell investors, hey, look, this is a one-off hit. It's not part of our normal ongoing business costs. This is for a long-term gain.
Let's go back to Meta. Huge severance cost, as you said.
Yeah.
How did that specifically impact their profits? And the really surprising part, how did investors react to such a big negative number? It just feels counterintuitive.
It absolutely is counterintuitive. So Meta's big severance and restructuring costs in late 2022, they led to this massive $4.2 billion restructuring charge in the fourth quarter of 2022.
$4.2 billion.
Yeah. And as a direct result, their net profit for that quarter, it was down a stunning 55% compared to the year before.
Ouch. So the stock tanked.
That's what you'd think. But here's the fascinating part. Meta's stock actually jumped nearly 20% right after they announced these results, despite that huge profit hit.
20% jump. Why?
Well, it seems the market saw it differently. It wasn't just about the cost, it was about the signal. Investors often see these kinds of drastic moves as a sign the company is finally getting serious about efficiency, about future profitability.
The year of efficiency thing they talked about.
Exactly. It's like the market decided this painful surgery now would lead to a much healthier company later, and they rewarded that proactive decision. They clearly bought into the idea that this restructuring showed financial discipline and would improve margins down the road.
That's quite a reaction. So the market looks past the short-term pain. Did we see similar patterns with Alphabet, Amazon, and Microsoft when their charges hit?
Well, Alphabet took most of its big charge, around $2.0 billion for severance, in the first quarter of 2023. And yeah, that directly lowered their operating profit for that quarter.
Okay.
Amazon's $640 million severance charge in Q4 2022 also played a part in them reporting their first net loss in years, although it's fair to say other factors were definitely involved there too.
Right.
And Microsoft, similarly, their $1.2 billion charge in their Q2 of fiscal 2023, that also reduced their net income for that specific quarter. So yes, the charges are significant. They definitely impact the reported numbers. But just like with Meta, Wall Street often looks through these one-off costs.
Looks through them.
Yeah, they tend to discount them when they're figuring out the company's core ongoing earning power. What investors and analysts focus on instead is the expected improvement in future earnings because, well, you have lower ongoing expenses now.
Fewer salaries to pay.
Exactly. And companies are usually pretty clear about this in their earnings calls. They help analysts adjust their models to focus on that future benefit.
And Tesla, once again, the outlier.
Yeah.
Different here because their upfront costs were so low, meaning almost no big charge to look through.
Precisely. Tesla's financial statements didn't really show these large, distinct restructuring charges because, as we said, their severance payments are minimal.
So no big hit to immediate earnings.
Barely any impact compared to the others. In fact, if you look back at Tesla's aggressive cost-cutting in 2018-2019, which included layoffs, that was actually a key reason they finally started achieving sustained quarterly profits. For them, it was almost an immediate boost to the bottom line because they skipped that big upfront payout phase.
Okay, so we've covered the big upfront costs, how they hit the books, and how Wall Street often reacts surprisingly positively. But the whole point of layoffs, the promise, is always about long-term savings. How quickly do companies actually get that money back? What's the real trade-off here for shareholders?
This is really the heart of the financial calculation, isn't it? Companies pay those significant upfront costs, specifically to cut their ongoing expenses, mainly salaries, benefits, maybe some overhead.
Right.
And what we've seen in many of these cases, especially in tech recently, is that the annual savings they achieve can actually dwarf the one-time layoff costs.
Dwarf them, really?
Yeah, often they can recover that initial outlay in, well, significantly less than a year. It's a big bet up front, but one that often pays off remarkably fast from a purely financial perspective.
Okay, give us the numbers again.
Yeah.
How much did Meta save annually compared to that $2 billion they spent on severance and restructuring?
Right, so Meta's charges were around $2 billion across those 2 rounds of cuts. But here's the kicker. Meta's management indicated that these layoffs, cutting over 21,000 jobs in total, would remove an estimated $5 billion in annual operating costs on a net basis.
$5 billion a year.
$5 billion a year. So you can see the long-term savings massively outweigh the one-time charges. That initial $2 billion cost was basically recouped in, less than 6 months of ongoing savings?
That's an incredible return on that painful investment. Was it a similar story for Google and Amazon? You mentioned Alphabet also had those office lease costs. Did that add to savings too?
Absolutely. Look at Alphabet. Their roughly $2.1 billion severance costs for 12,000 employees. That likely removes somewhere between, say, $2.5 billion and $3 billion in annual costs.
Again, payback in under a year.
Easily under a year, just on salary savings. And yes, that extra $856 million Alphabet spent getting out of office leases, that should lead to lower rent and depreciation costs in future quarters, boosting the savings even more down the line.
And
Amazon's estimated $1 billion total severance for about 27,000 corporate roles is projected to save roughly $2.7 billion per year in labor costs. So again, yes, recouping that initial billion well within a year. These cuts for them were part of, bigger cost optimization plans aiming for multi-billion-dollar annual savings. And it's not just big tech, If we broaden the view slightly, companies like Disney, Goldman Sachs, they showed similar kinds of financial returns from their layoff programs. Well, Disney cut 7,000 jobs. Estimated severance cost maybe a few $100 million, but those cuts were expected to contribute $2.5 billion towards their bigger goal of $5.5 billion in annual savings.
Wow.
And Goldman Sachs, over in banking, they spent about $275 million on severance for around 3,200 jobs, but they expected $500 to $600 million in annual savings just from those cuts.
It's a pretty consistent pattern across different industries.
It seems to be. Significant upfront costs, yes, but often a very rapid payback period through those ongoing savings.
And let me guess, Tesla. Unique again, because their minimal severance costs mean the long-term savings are almost pure profit right from the start. No big initial cost to claw back.
Exactly right. Tesla's super low short-term cost means almost no noticeable hit to their financials in the quarter the layoff happens. Take their 2024 cut over 14,000 employees. That could save them anywhere from, say, $700 million to maybe $1 billion a year in costs.
And since the payout was tiny?
Since the payout was tiny, almost all of that future saving drops straight to the bottom line, immediately. It gives an instant boost to their profitability profile. It's a very aggressive approach to cost management, definitely a hallmark of how they operate. But this does raise, I think, a really important point. While the financial math often seems to work out quite clearly, are there hidden costs? Intangible things, longer-term risks that don't show up so neatly on a spreadsheet.
Yeah, that's what I was wondering. It can't all be positive, can it?
No, absolutely not. There are definitely significant intangible costs, things that are much harder to put a dollar figure on.
Like what?
Well, probably the most critical is the loss of institutional knowledge and expertise. When experienced people leave, you lose their skills, their understanding of how things work. That can lead to project delays, maybe a dip in product quality, even missing out on new ideas or innovation.
Yeah, that makes sense.
And then there's the hit to employee morale among the people who remain.
The survivors.
Exactly. It can create this climate of fear, uncertainty, impact productivity. And sometimes your top remaining talent might start looking elsewhere too, leading to, a talent drain over time.
So companies have to weigh that too.
They absolutely have to. They need to balance these clear financial upsides with these potential harder to measure long-term downsides.
Yeah.
Because some companies have found that after cutting really deep, they actually needed to rehire later to fuel growth. And sometimes they end up bringing people back at even higher salaries than before.
Wow. What an incredibly eye-opening deep dive this has been. What I'm really taking away is that for these huge S&P 500 firms, layoffs, while obviously so difficult for the people involved, they are often a very calculated financial move.
Yeah, a tool in the toolbox.
Right. They pay these significant one-time HR costs, which definitely hurt earnings in the short term. But they do it with a really clear expectation, and it seems an expectation that's often met, of making the company financially stronger in the long run, mostly through cutting those recurring expenses way down.
The data we looked at, especially from the last 5 years or so, it really does show that the annual savings usually dwarf those one-time charges, often paying for themselves within just 1 year.
Incredible.
And like we saw so clearly with Meta, the market often rewards these announcements, which tells you that investors generally believe that long-term efficiency, that improved profitability, it outweighs the immediate cost. They're betting on a leaner, more focused future.
It's that classic case of short-term pain for long-term gain. But with that weird twist, the market often seems to applaud the pain itself.
So yeah, the next time you see a headline about a major company announcing big layoffs, hopefully you'll have a deeper sense that it's not just about the immediate job cuts. It's actually a strategic and pretty expensive investment in what they hope will be a leaner and potentially more profitable future.
And that brings us to our final thought for you listening today. We've talked a lot about the pretty clear financial benefits companies get from these layoffs. But considering those intangible costs we just touched on, things like morale, losing expertise, where do you think the line is? Is there a point where the drive for efficiency through layoffs actually starts to become a detriment to the company in the long run? When does cost-cutting go too far?